Welcome back to Accounting 2. This video called S-Corp Basis, this lesson, I have to warn you, it's going to be really boring. And it is one of those really dry topics in tax that I need to teach you, I need to show you, I need you to understand pieces of how this stuff works. But just know as we go through this, Halon and the CPAs behind Halon, this is one of the main things they're watching for. They're watching to see if there's a tax return that comes across our desk that does not have enough basis to cover distributions or a loss or something like that. So we are watching for this. We are calculating this. We are, not going to make this a part of your day every time we do a tax return. But it is something we're watching. However, you need to have some idea of what it is, how it works, all of that. So bear with it. I don't think this is a terribly long video, but at the same time, I got to warn you, it's going to be a little boring. But let's jump into it. Let's make the best of it. And then I've got some more exciting things for you in Accounting 2. So first, I thought we would cover why we need to understand basis. It's important during the tax year because it must be there to offset distributions and losses. So think of basis as a good thing. Think of basis as something that covers you, that more basis you have, the better in almost anything, I would think. So in this first bullet, the first reason we need it is to cover distributions. This means that if I take money out of the S-Corp in the form of a dividend, a distribution, if I want that to not be taxable, then I need to have basis. Now, this doesn't mean that the taxpayer doesn't pay tax on income. The taxpayer is going to be paying on the net profit, whatever the S corporation is making. But this is, you could take a distribution, and if you don't have enough basis, not only do you have to pay tax on the income the S-Corp made, you also pay tax on the distribution. Crazy, right? It's kind of like being double taxed. So having this basis is important. And the first piece of this that we're going to cover here is the distribution side of it. You have to have enough basis to cover whatever distributions you take out of the company. Same thing when it comes to if the S corporation runs a loss for the year. Like loss meaning expenses were more than income, right? That kind of loss. You have a net loss. If the S-Corp did not have basis to cover that loss, then it is not allowed, or part of it may not be allowed to be taken in that tax year. And that's bad too, right? Because that loss could reduce income from other sources for the shareholder, and the taxpayer ends up paying more tax because they couldn't enjoy all of these losses that this S corporation was creating. And that can be just as bad as an extra tax, right? It definitely can be. So covering losses is the second piece. And the third issue is when the company is sold. This is a less common issue, but one that must be taken into account, as it will determine the gain on the sale of the company. So if you have $20,000 basis and you sell the company for $40,000, your gain is the difference between the two. If that makes sense. So basis is important whenever you're selling the company as well. So those are the three reasons we need to think about basis. Let me kind of show you how we calculate basis, and then here in a little bit I'm going to take you through some examples of each of these, and you'll understand it a little bit better. So kind of think about basis like a checking account. The account goes up and down. It can never go negative. Okay? Let me say that again. It can never go negative. When there's a deposit of income, okay, when the business makes money, the basis goes up for all of the shareholders based on a percentage of their ownership. But just know that the basis goes up as you earn money. When there's a payment of an expense, the basis goes down. So just like a checking account, income basis up, expense basis down. When a shareholder contributes money to the company, right? Like let's say the shareholder puts money in, the basis does what? It goes up. When the shareholder withdraws money, the basis goes down. Basis can also be decreased by several, kind of different activities, like any penalties that the company has to pay, Section 179 expense. You remember that from depreciation, bonus depreciation, all of that. There's the non-deductible portion of meals. So meals are only 50% deductible, but that other 50%, that actually decreases basis still. Does it? It's not deductible, but it decreases basis. So, kind of be aware that, all the meals you're eating out and deducting through the business, half of those meals are eating up your basis. Now, is it the worst thing in the world? Because you still had an outflow. So I'm not trying to make the point of, hey, don't deduct business meals. I'm just saying when it comes to basis, you need to know that is an outflow that, 100% of whatever you spend on meals. So kind of think of it like this. In year one, you start out with zero basis, right? When you first start the company. For the activity of the first year in business, you then have an ending basis. So whatever the income and the expenses and how much money you put in, how much money you took out, that's what the end of the year basis is. The ending basis in year one, this may be intuitive, but let me say this. The ending basis in year one is your beginning basis for year two. That makes sense? It continues. It's like a running ledger all the time. This continues as long as you have personal ownership of the company. So on the screen, I have a worksheet that kind of gives you an idea of all the ways basis goes up and down. And you can just take a look at it here while I'm talking and kind of just see all the things that make it go up, all the things that make it go down, and kind of just have it in the back of your mind. What matters most is what the basis is at the end of each year. Because based on that, we may find out we have a problem, right? After we figure out what the basis is at the end of the year, if we've got distributions that exceed our basis, that kind of thing, we may have a taxable event. And that's kind of the reason I'm teaching you this, is to be aware of what creates the bad guys. And I'm going to show you kind of towards the end how, like, the real things to be looking for. Let me show you first an example of this distribution issue, like when you run out of basis when you do distributions. So most S-Corps have basis at the end of the year. Then what we do, we take a look at what their distributions were. Now, keep in mind, we're not talking about payroll, okay? We talk a lot about payroll in other lessons, right? We're not talking about payroll here. We're talking about the actual distributions from the S-Corp that are exempt from self-employment tax, okay? When you have enough basis, those distributions reduce basis further. But so long as your basis doesn't go negative, everything's fine. And you move on to the next year. You figure out what your ending basis is after all your distributions. That becomes next year's beginning basis, and you move on, and it doesn't matter. And that's what 99% of your clients are going to be. But let's say that you have distributions in excess of this basis. That amount that's in excess is taxed at the capital gain rate. Okay, so let me kind of show you. I've got these examples here. So on this first one, this is the good guy, no tax. So the basis at the beginning of the year, let's say this was like year 3. The basis at the beginning of the year is $41,000, and they made net profit on the tax return of $20,000. This is simplified a little bit because we probably would need to reduce their basis for the 50% meals that wasn't deductible, that kind of thing. But let's just say it all added up. There were no meals, let's say. And ending stock basis ends up, you add these two things together, because when you make money, you're actually adding to last year's basis, right? Then you have distributions of $25,000, which wouldn't be crazy, right? If they made 20 grand, they could distribute 25,000 because maybe they've got some cash in the bank from prior years or something like that. And their basis after the distribution's 36 grand still. This is good. This is a year where you don't have to really worry about it. You have to track it still, and that's what Halon does. But you don't have a problem in this situation. Over on the other side, it's a little different. So and this is going to give you your first hint of where basis starts to go wrong. And it starts to go wrong when companies start losing money. Okay, that's when it really starts to get bad. And I'll go over more of this here in a second. But here the basis is the same. The start basis is the same, 41,000. And then we have a current year loss. So they lost money. So the ending stock basis before their distributions was 16,000. Then, even though they lost money, they pulled another 25 grand out. Now we have a problem. Because this runs the stock basis negative, it means the basis after the distributions is zero. Remember, it can never be negative. And the difference, the amount that it would have been negative, is a capital gain that shareholder has to recognize on the 9,000. So not, they did get to deduct the losses for the year, but they had to pay capital gains on their distributions, if that makes sense. So this is bad, right? Now, this is kind of a weird situation, and you need to be thinking through this like, wait, why if they lost 25 grand and they had $16,000 of basis left how did they even pull $25,000? I'm going to show you here in a second, but that's a key. Like, it's very rare that these S corporations have money that they can pull out that exceeds their basis, and we'll talk about that some more. But the big point here is you have to have basis or else distributions are going to be taxable, right? All right, let me show you the second one, which is when a company runs a loss that they can't take. So let me pull that one up. So in this example, this is what we call suspended losses. The loss that the business had gets partially suspended and carried forward, okay? The business starts with only $10,000 of basis, but then has that loss of $25,000. There's not enough basis to offset that whole loss. So the shareholder gets to report $10,000 of that loss as loss because that's how much basis was left over. And the rest of that loss, the $15,000 loss, is what we call suspended. And it's carried forward into future years when you have basis. So, how would this person be able to actually recognize the full 25,000? They probably need to put 15 grand back into their business or something, right? To where their basis goes back up and they can recognize the whole 25,000. But again, I'm going to show you here in a second kind of how these companies get to where they can distribute cash that's in excess of all of their basis. The suspended losses and the distribution tax are kind of the two bad guys. That if you're not watching basis, and this is what my folks are watching for, if they see something that looks like this, we're going to dive into it more and say, I wonder if there's, a basis problem here. To make it a little more complicated, let me show you that there's actually not just one, there's two kinds of basis. Okay? And most of what you hear about it involves stock basis. Okay, that's what we've just been using as stock basis. But that's only one part of the puzzle. There's also something called debt basis. This is when the shareholder makes a direct loan to the business. The shareholder loans the business money. Does that make sense? When that happens, their debt basis increases. And when the company pays the shareholder back, like pays the loan back off, the debt basis decreases. The total of stock basis and debt basis is really what you have to watch, okay? So if they're lending money to the company, that increases their basis. You kind of add up the stock basis and the debt basis, and that's the number you really got to make sure doesn't get negative, or else you're going to have these taxable events. If you had a corporation that ended up having debt basis that kind of made up for their zero stock basis, and then the company pays the debt off, this is kind of where debt basis gets weird. If, let's say the stock basis was already zero, and then they lent the company money, $20,000. Great. And, now they have basis again. But then, after they had taken a distribution of $20,000, the company pays the debt off. Well, now that debt payment is taxable. So there's no way around this basis thing. Even if you loan money to the company, you can't then have the company pay you back. And again, the question should be on your mind, well, how would the company be able to pay the debt off if it had zero basis? And where does it get the money and all of that kind of thing? And, by now, I'm sure your head's kind of spinning, basis. Let me kind of show you some of these situations where companies really get into a problem here, and you'll start to go, I kind of see what the trigger point here is. So 99%, as I've said, of my clients don't have a basis issue and probably never will. This is because there is one thing that will create a situation more than any other that has to be watched very closely. It is a very common trigger for basis issues, and here it is. The business takes out a loan, and that loan is in the form of cash. So if a business takes out a loan against a car or something like that, you may not have an issue like this because they're not getting cash. Thus, they can't really distribute that cash out. But when a company takes out, let's say, a $20,000 loan, gets a note in receipt, signs a promissory note, and they just get cash that they slam in the bank account, what could they do with all that cash if they wanted to? They could distribute it, right? They could distribute it. And even if the shareholder guarantees that loan, courts have said it does not count as basis. If the loan is in the company's name, that is a company loan, and if they distribute that money, you better have enough basis to do it, because if you don't, it's going to be taxable. So what's the trigger event? The real trigger event is these loans. Let me take you through these examples I've got here. So get my laser pointer back out. Here's the first one. Basis at the start of the year. They have a current year loss. So this is the first year, and right out of the gate, they lose money, $25,000. Now, in order to lose $25,000, what would you have to do? You'd have to put $25,000 into the company. Unless you're borrowing money, if you're not doing any loans, the only way to get a $25,000 loss is to put $25,000 of something into the company at least. You might have put more. That means that at the end of the day, you have a $25,000 loss, but you put money in of $25,000, so your ending stock basis is zero. Now, if you put $25,000 into a business and you lose it all, is there any money left over to distribute? No. So your distributions are going to be zero too. Basis after distributions is zero capital gains. This all is fine. This scenario right here is just fine. And how it happens a lot of times, they can't distribute more money than they've got or that they put into these things, right? Let's go over to this other one. Basis of zero starting out, made income the first year. That's great. And they put $25,000 in at some point, right? So their ending stock basis is $40,000. The income they made plus what they put in. If they want to pull all of it back out, right? They made $15,000 plus they put in $25,000. All of that could be sitting in cash, right? At the end of the year, $40,000, and they decide to pull all of it out. They want everything out of the business. Retained earnings would be zero, all that, right? Still, that's okay, because the basis after the distribution didn't go negative, so there's no capital gain or anything here. So this situation is fine. Here's where it gets goofy. Basis at the beginning of the year, zero. Current year income, $15,000. They put in $25,000. Ending stock basis is $40,000, right? The company takes out a loan from My Cash Advance or something, gets $20,000 in exchange for a promissory note. They slam that into the bank account. So now they've got $60,000 in the bank account, right? Because they took this note and they made $15,000 plus they had the cash that the owner put in, or the value at least that the owner put in. So they've got the 40 plus the 20,000. They've got 60 grand in there. So this person distributes 50 of it at the end of the year. Whoops. Because their basis was only 40 grand. This 20 grand did not increase it. This 20 grand did not increase it. Now, how could they have done this? They could have taken out a personal loan, right, that had nothing to do with the company, and then put the money into the business and then pulled it all back out, and that would have been fine. Because when they put the money in, instead of capital contributions of 25, it would have had this too, and they would have had capital contributions of 45. But when you put that loan in the business's name, the basis doesn't go up. The distributions, you basically distributed part of the company's money to you. And the IRS says, nope, you have taxable income now of 10 grand, the difference between what your basis was and the distribution. Does that make sense? This is the situation you want to watch out for. If you've got clients that are borrowing money for cash, putting it in the business, and then doing lots of distributions and things like that with it, you more than likely could easily end up with a basis situation. What's another way that what's an easy way sometimes, not all the time, but sometimes to see if basis might be an issue? That's looking at retained earnings, right? Because if they end up with more liabilities than they have assets, that means they've taken on some kind of liability and distributed it out somewhere. Now, retained earnings, you can't just look at retained earnings. You got to look at capital contributions. You got to look at all the shareholder distributions, the whole equity section. But if your whole equity section's negative, you easily could have a basis problem there, because it may, and that's what my team, gals and guys, are going to be looking for too. So that's the real danger zone. So, and if you get clients like this, just make sure you get us involved. And when I say get us involved, I mean hit the customer service button, chat pops up, say, hey, I think I've got a client that may have a basis issue and I need to talk to one of the CPAs, as part of the CPA tax team. I need to talk to somebody about it. And we're going to route you to someone to talk to you about it, take a look at everything, and figure out if we do have a situation like that. Get ahead of it if you can. If not, no big deal. We're going to look at it during tax time. And by the time, here's the problem with looking at it during tax time, the year's over, right? So now there's nothing that can be done. You can't go back and put money in. Because most of the time that's kind of a way to fix basis, is take some money and put it back in before the year ends. That way your basis gets jacked back up and you don't have these issues. So that's why you guys are on the front lines trying to watch basis here. That is all of it. Not too long of a video. And I only have one action note, and it's this, right? And I don't mean, I'm a little tongue-in-cheek here, but I don't mean to be, but it really, this is what I need you to be doing. Watch the basis when companies take out cash loans, right? When you see companies that are in your portfolio doing this, put an eye on them and watch them. And if it's looking like by the end of the year they've got some negative basis, you need to let them know, let us know, and we'll try and help them make sure that they don't have some kind of taxable event. So that's it. Shareholder basis in a nutshell. There's a lot more to it. I'm here to tell you there's a lot more to it. And if you want to research it on your own, I would absolutely encourage that. But for now, I have much more to show you in this Accounting 2 module. So I'll see you over in the next lesson, and thanks for watching.